For most of the 20th century, there was a simple expectation: work hard, save money, buy a home. It wasn't glamorous advice. It wasn't even interesting advice. But for a large portion of the population, it worked. A single income could support a family and eventually a mortgage on a modest home. That expectation is now breaking down in cities across North America, Europe, Asia, and Australia. Prices have risen far faster than incomes, in some markets for decades. And a growing share of people who did everything right are still renting in their 30s, 40s, sometimes beyond. So what happened? Did homes suddenly get dramatically better? Did land secretly become scarcer? Did an entire generation collectively forget how to save money? Or did the system change in ways most people never noticed, while they were busy doing everything they were supposed to do? In the 1950s, 60s, and 70s, homeownership rates across the developed world were rising. A factory worker, a teacher, a mid-level government employee, a single income could reasonably carry a mortgage on a modest home. This wasn't because those generations were more disciplined or harder working. It was because the ratio made sense. In the United States in 1970, the median home cost roughly 3 times the median household income. In most major cities today, that ratio is 6, 8, 10 times, and higher in some markets. The house didn't get 3 times better. The land didn't get 3 times scarcer. The math just changed. Homeownership rates in the US peaked at around 69% in the mid-2000s and have been declining since. The UK, Australia, and Germany show similar patterns. A generation that owned more, followed by one that owns less. The latter didn't disappear. It just got longer. Quietly, while nobody was announcing it. For most of history, a home was primarily a place to live. You bought it, you lived in it, and if you were lucky, it held its value. That was the deal. At some point in the late 20th century, that framing began to change. Homes started being discussed as investments, as a store of wealth, as an asset that could appreciate, as the core of a retirement strategy. Real estate became something you bought not just to live in, but to profit from. And once enough people believed that, the belief became self-reinforcing. If you expect prices to rise, you buy sooner. You stretch further. You pay more than you otherwise would, because waiting feels expensive. And when enough buyers think this way simultaneously, prices do rise, which confirms the belief and pulls more buyers in. Then came the early 2000s, when that belief went fully mainstream. House flipping became a television format. Buy, renovate, sell for profit. Ordinary people, not just investors, started treating homes as trading vehicles. The 2008 crash briefly interrupted the mood, but the underlying logic never left. And when rates dropped again after 2008, it came back stronger. Housing had shifted from a consumption good, shelter, to a financial asset. And financial assets behave very differently from shelter. Shelter doesn't need to deliver returns. Shelter just needs to exist. Here's where it gets structural. If you've watched our episode on the Federal Reserve, you already know the mechanism. For roughly 2 decades following the 2008 financial crisis, interest rates across the developed world were held at historically low levels. Central banks in the US, Europe, the UK, Canada, and Australia kept borrowing cheap to stimulate their economies. That was the goal. Housing was not the goal. What does cheap money do to housing? It increases purchasing power. If rates drop from 7% to 3%, the same monthly payment now supports a much larger loan. More borrowing capacity enters the market. More buyers can afford, or believe they can afford, more expensive homes. And when more money chases the same number of houses, prices rise. This is not a complicated mechanism. It's just supply and demand, with the demand dial turned up. The Federal Reserve wasn't trying to make housing unaffordable. It was trying to prevent a depression. The unaffordability was, as economists like to say, a side effect. You might expect that rising prices would trigger more construction, more demand, more supply. That's how markets are supposed to work. In housing, it's more complicated, largely because a lot of people who already own homes have a strong preference for things to stay exactly as they are. Land in desirable areas is limited. Zoning laws in many cities make it illegal to build the apartments or townhomes that would house more people. Single-family zoning covers the majority of residential land in most major American cities. Permitting processes are slow. Neighborhood opposition to new development is real, well-organized, and often effective. The result? In the cities where demand has grown most, where the jobs are, where people want to live, housing supply has not kept pace. Prices rise when demand increases. They rise faster when supply can't respond. And supply, in most desirable cities, cannot respond quickly. There's one more layer that gets less attention. Over the past 2 decades, institutional investors, pension funds, private equity firms, real estate investment trusts have moved into residential housing at scale. In the United States, large investors purchased roughly 1 in 5 homes sold in major markets at the peak of their activity. Corporate landlords now own hundreds of thousands of single-family homes that were previously owner-occupied. It would be easy to frame this as corporations behaving badly, but that framing misses the mechanism. Institutional buyers are responding to the same incentives as individual investors. Housing was delivering returns. It was a stable asset. They followed the math. Nobody at a pension fund held a meeting to discuss how to make life harder for first-time buyers. They held a meeting about returns. The harder life for first-time buyers was incidental. No single institution set out to make housing unaffordable. They set out to generate returns. The unaffordability is the side effect. There seem to be a lot of side effects in this story. This is not a uniquely American problem, or a British one, or Australian. The same pattern appears in Canada, Germany, the Netherlands, New Zealand, South Korea, and in smaller markets too, including Serbia, North Macedonia, and much of the Balkans, where urban prices in the last decade have climbed well beyond what local incomes can easily support. Different countries, different regulations, different governments, different cultures, different histories, similar outcomes. That's the signal. When the same result appears across very different contexts, it usually means the underlying forces are structural, not local policy failures, not bad luck, not a generation that forgot how to be responsible. The incentives are similar, so the outcomes are similar. What does this actually cost? Not just in money, in behavior. People delay starting families because stability tends to come before commitment, and the path to stability got longer. People stay in cities or jobs they'd otherwise leave because moving means re-entering a market they can't afford. Wealth accumulates with those who bought early and transfers less easily to those who didn't. Home ownership has historically been one of the primary mechanisms by which middle-class families built wealth. As that door closes for a larger share of the population, the gap between those who own assets and those who don't continues to widen, and the gap compounds. In several countries, parental wealth is now one of the strongest predictors of whether someone will own a home. Those with asset-owning parents get help with a down payment. Everyone else starts further back. The divide doesn't just persist, it deepens with each generation. Which is a polite way of saying it becomes harder to escape. Housing became unaffordable not because of one decision or one actor. It became unaffordable because several forces arrived at the same time. Homes were reframed as investments, cheap money inflated purchasing power, supply failed to respond, and institutional capital found a new asset class. Each of those forces made sense within its own logic. Each was, in isolation, defensible. None of them was designed to produce the outcome they collectively produced. That's how most systemic problems work, not through malice, through incentives that each seem reasonable until you see what they add up to. If this was useful, hit like. It helps more than you'd think. And subscribe if you want to keep looking beneath the headlines.